On to the next session, what I'm really excited about, this is focused on the future of sustainable investing. As I mentioned, Natalie Kenway, Global Head of ESG Insight at Bond Hill Media, is going to moderate the session. Natalie has been instrumental in giving sustainable investing a voice in the media, championing awareness and education for all things sustainable. She's joined by Matt Pitcher, Louisiana, Salge, and Hannah Simmons. So thank you.
Thank you, Sophie. That was very kind. Thank you very much for having me along today. Looking forward to getting stuck into this topic. So what is the future for sustainable investing? Would you like to all just briefly give an intro to yourselves, what you're focused on?
Sure. Louisiana, Salge. I work at EQ Investors. Met a lot of you either virtually or in person before, and it's great to have you all here. I work to basically, in a really short format, my job is to make sure that the sustainable objectives we set for the portfolios are actually maintained, reported on, engaged on, and the ambitions lifted year on year. That's it.
Thank you very much. I'm Hannah Simons. I actually work for Schroders, so I'm delighted that you're all joining us in our office today. In my role as Head of Sustainability Strategy here at Schroders, I support our clients in understanding more about sustainability, but also importantly, hearing back from our clients where they are on that journey to make sure that the products that we're developing, that you're then also looking at to make sure the claims we make are appropriate, are actually aligned to your client needs. Thank you.
So I'm Matt Pitcher. I'm managing partner of Altor Wealth. We are a mid-sized independent financial advisor down in Hampshire. So 4 advisors. We are also a B Corp as well. And a lot of the work we do for clients, not exclusively, I have to say, but a lot of the work we do is around ESG and sustainable investing.
Great, well, it's great to have the different elements of the investment chain here with us today. Thank you. In the intro, Damien and Sophie were talking about the impact of regulation over the past 10 years, and we've recently seen the FCA launch its sustainable disclosure requirement consultation. So that's looking at sustainable disclosures and investment labels. Louisiana, could you talk a bit more about that, set the sort of regulatory landscape for us at the moment?
Sure, I'll keep it short because you've already heard a bit about it. But in general, as Damien outlined, the regulator was previously not engaged or interested up until about 2020. What that meant is that client demand was really driving the take-up of sustainable investing, and it was growing, but it was not growing under any guidance. So what was happening is that sustainable products were kind of ballooning, but unfortunately there was no necessary disclosure requirements or even minimum standards attached to this. And what that created was a lot of investor demand because, as we know from the last FCA survey, about 80% of clients, when asked, want to invest for good as well as for financial returns. So there was a lot of demand, but this well-intended capital was often going to the wrong places. So naturally, the regulator thought, we need to step in there. The EU started off with SFDR and a couple of other requirements, including MiFID II, which is specific to advisors. And what happens there is that they set up the scene, the FCA followed, and in general, I think they follow similar aims with slightly different implementation, but the main aims is to channel capital that is intended for sustainable investing towards sustainable growth, real sustainable growth, increase transparency, so more disclosure related to the intention of financial products. If they want to have a sustainable objective, they need to report on that and be clear about what it is and what it isn't. And then lastly, really, to make sure that we are preventing greenwashing from happening going forward and kind of counteracting, unfortunately, the lack of trust that has built with some clients, and make sure that we maximize the flows towards sustainable investing going forward.
Great, thank you. And yeah, as you mentioned, this broader approach from the regulators and SDR, it's to tackle greenwashing, protect clients from greenwashing. Hannah, as an asset manager, what's your approach to this? How do you make sure that the companies you're talking to aren't greenwashing?
I think you did an excellent job distilling that complexity in just a few moments. But I think that piece you landed on, and that your first question, Natalie, all around greenwashing, is truly at the heart of much of the regulation we're seeing, not just in Europe and the UK, but also globally. And when we think about greenwashing at Schroders, we actually look both inwardly at the things that we're doing, and then I'll come on secondly to the transparency we then provide to our clients to demonstrate what it is we're doing. But we've basically put in place a series of governance structures to make sure that from our own business, we are looking at and checking, if you like, because ultimately with greenwashing, what you're trying to avoid is that you've made a claim and you can't stand behind that claim. So as you would expect, part of this is about the governance you put in place. So ultimately, the board of Schroders is responsible for everything that we do. But how we avoid greenwashing is through things like our ESG Exec Co, which is responsible for setting the long-term strategy and our strategic priorities around sustainability. And that group spans the entire business of Schroders. So you have the distribution voice. So what are we hearing from our clients? We have our investors. What tools do they need to be able to assess companies? And of course, you would expect we have legal and compliance and those organizations. So that's a core part around the governance that we've established. The second level is then actually how we think about oversight and risk management. And across our business, we've put in place essentially the 3 lines of defense approach. So investment risk that sits embedded within our investment teams are checking, are understanding what it is that our investors are doing around sustainability. Our group risks function is then using some of the data that comes from our sustainability tools to assess and question the investment teams on the decisions they've made. So why, for example, in your portfolio, do you have this level of carbon emissions? Why, when we look through a sustainability tool that Schroders has created, does your portfolio look like this relative to the benchmark? Mm-hmm. And of course, you won't be surprised that the third line of defense is our internal audit function, so independent to our investment teams. So that's a core part of what we've been doing internally to make sure that we have multiple ways of checking and reviewing the approach we're taking. Then how we talk to our clients, that comes down to how we report and the transparency we offer there. And that's an area that over the last 2 years, we've been enhancing ourselves. So through our sustainable investment reports that outline the engagements that we've had. I know we've got Catherine coming up later talking about the importance of engagement. So what engagements are we undertaking to support companies in their journey around sustainability? What research have we undertaken into topics like, we have a focus on biodiversity and nature coming up. So what is the research that we're doing? All of this is, again, evidence of how we can demonstrate to our clients what it is we're doing, so that then you can judge on the quality of that.
Okay, fantastic, thank you. And Matt, so taking into account what's already been said, how does the SCR and the regulations against greenwashing affect the advisors in the room, and what would be your top tips for the advisors to sniff out the greenwashers?
Top tips for dealing with regulation, that's going to be an interesting one. So I tend to take a positive view of the regulator in most things, just in case there's anyone in the room from them. The paper itself, actually, I thought was a good one. It's a reasonable read for an FCA paper. I think, despite the fact they're still calling us distributors, which I object to, I think there's some really clear signs from them about the way they plan to regulate this space. And I think I'm a big fan of being ahead of the regulator if you can possibly get ahead of them on this stuff. So it's really clear, I think, 3 things probably. So they're going to require firms, or they're going to require us to ask the question. And I think just asking, are you ethical, is probably for the past. So detailed questioning around the client's personal preferences, and then having solutions prepared and ready for whatever answer you get from a client. And then the bit that makes me slightly nervous at the moment, or I think we've probably got a couple of years for implementation, is it looks as if they're going to require us to provide disclosure to clients. So not only will we be giving clients performance disclosure, we'll be giving them cost disclosure, and then we'll be giving them some form of sustainability disclosure as well. Quite what you do with clients who are unethical, I don't know when it comes to sustainability disclosure, but the general direction actually I think is really positive, because I think it's going to force more and more people to think about it, by which I mean advisors. And for the people in the room, you're already doing it. And that's a huge advantage to be so far ahead of the majority. When I talk to a lot of our peer group, they're so far behind that there's a huge business opportunity for those of us who are already at least talking to clients in this space, to actually start to differentiate what we're doing.
Great, thank you. And Lou, you're close to all of these conversations as well as close to the retail client. So how do you digest all of that information for better client engagement?
Yeah, it's a good question. And I mean, I mentioned earlier that the regulator has been primarily absent. So what we've been doing so far and what Damien has been touching on is something that we needed to do in order to see through what was unregulated all the way from something that I would really call out now as greenwashing to something very highly intentional, and actually have a way to sift through the process that wasn't necessarily unified, as well as the underlying holding. So what we've done over the, I guess, last couple of years is really develop our own view of looking through every single fund that we hold and why we hold them, and to be able to test back the intention, no matter what it says on the tin. It could be called something that has nothing to do with sustainability at all, to be able to test that and have a consistent view across different funds in a given strategy to make sure that there's nothing that we avoid greenwashing. And we use that then, which is, I guess, the more material point, is that we use that then to question, monitor, and push the ambition of the fund managers. And then together, these two aspects, the monitoring and the pushing, results in our client reporting. And our client reporting has always been done in collaboration with our financial advisors. We've developed the different tools, as well as our engagement reporting, showing our milestones that we've actually developed in-house that didn't exist before, engagement milestones. So we really try to showcase that in a world where clients can be worried, we're trying to give them reassurance that we meet the sustainable objectives that they expect from us, because you consider them suitable to our portfolios. And we're excited about regulation, trying to get more disclosure out there, because that helps us make better decisions as well, right? So unfortunately, I think there's going to be quite a while until there's enough information out there that, or at least enough detailed information out there to make sure that every client meets exact preferences. But that's what we're here for.
Great, thank you. I think there's definitely been an increased focus on transparency and that sort of calling people out, calling groups out as well this year. So it's good to hear how that all comes together in your conversations. So we've spoken about regulation as a push factor for the future of sustainable investing. But what about the pull? How is the client demand changing? Matt, I wanted to ask you. So Sophie mentioned earlier that sustainability means different things to different people. So what do you see in your clients' preferences, and how do you accommodate their different levels of understanding?
Yes, it's a good question. So I tend to take the view actually that a lot of clients don't know to ask, and therefore very often it's advisor-led when you look at an advisor's bank of clients. So I suspect at the moment there's a huge amount of latent demand that isn't being provided for at the moment, because the question isn't being asked. And back to the point I was making earlier about how you ask the question, I think how you frame the question makes a huge difference to the response that you get back from clients. So certainly I know with the advisors that we have, we've been playing around a bit with the questions we ask to give a bit of a pull as well as a push from the clients. Because some clients have approached us. So notably, we had two off the back of Glasgow COP last year who came to us and said, I want to restructure my entire portfolio to align with Paris 1.5. But actually, that's just two out of all of our clients. As soon as we started changing how we asked the clients what they cared about, that makes a huge difference to the numbers in terms of their engagement with this topic. We've done it in good ways and bad ways. We've played around with the questions we've asked. We've tried asking if a client wants to invest unethically as our launch, and you'd be surprised. Actually, there are some clients who do want to invest unethically, but they're in a tiny minority. And if you compare the splits with the splits that we see out there in the wider world, then it's clear that the question isn't being asked properly. So I think if we can get that solved, and I think some of the regulation will help with that because it will start to prompt, then I personally, I just think there's this huge desire out there for this to be taken into account. Probably the most successful thing for us is just the framing of what is it that you don't want to invest into. I think the concept of an ethical investor comes with some baggage for a lot of people. So a lot of people would say, well, I'm not an ethical investor. If you say, is there anything you don't want to invest into? A lot of our clients have got personal stories about someone in the family who, maybe gambling led to a bad outcome, or smoking. I mean, you can list off all the obvious stories that are probably latent in those client banks. And as soon as it's one thing they don't want to invest into, then they've shifted. They've moved into a whole different world of investing from where they were before. So look, maybe I'm wrong, but I think this is likely at some point to reach a tipping point where it becomes normal, and then impact perhaps is the sort of next level on, rather than unethical, ethical.
Yeah, great. We've got some more questions on becoming mainstream later on, but and Lou, I mean, you work quite closely with IFA clients like Matt and for a few years. How does what Matt just said influence what your work at EQ and the conversations you're having?
A lot. I think innovation, Damien mentioned that innovation so far has been, of course, driven through, us doing the work ourselves, looking at, for example, where the institutional market is going, so the big pension funds, the big insurers, because sometimes there's an edge there that the retail market hasn't caught up on. So that's been driving our innovation in some ways, as well as, of course, listening to our IFA client, underlying client conversations as well. I think there's some bits of it which are also innate to political changes. So we had COP as a big influence, and we've seen this in the demand for climate action portfolios, for example. We've seen questions around armaments and the ethical situation about investing in armaments in a geopolitical era where we are close to a war geographically, which we haven't been in a while. So I think there's a lot of things that are influencing our innovation, but importantly is that we always look for feedback, and then that's how we innovate going forward. And keep in mind the challenges that we want to actually channel capital towards, because we're really far away from meeting some of the goals that Damien mentioned earlier, the UN Sustainable Development Goals. The climate crisis hasn't been solved, and we as a firm, as a B Corp, as well as just generally thinking about the systemic impact of capital, we're always trying to think about how we can lift ambitions and cater for more well-intentioned client capital to actually meet the challenges that we're facing. So I think all of these factors.
Okay, great. Let's stay with on that innovation point, and as we're talking about the future of sustainable investing, Hannah, I wanted to ask you: have you seen innovation coming from institutional investors into the retail and advisor market? Maybe somewhere in product development.
And Louisiana, I'd like to comment just a moment ago when you were saying, are there things that you can learn from, and seeing potentially quicker moves from some of the institutional? So I thought I'd share some of the insights, and I think it's fair to say, and I'd also noted Sophie's comment about sustainability means different things to different investors, because again, you are approaching sustainability from that full spectrum of where clients are on their journey. So there are some clients that are very early and do think much more about, what do I want to invest in? What do I don't want to invest in? So that ethical position. And then you have clients at the other end of the spectrum that are much more purpose-led and thinking about, how are their investment pounds actually having a direct impact, and that additionality piece. And what we're seeing at the moment, I think it's fair to say, is innovation happening in all of those different places. So my sort of main comment is that I'm seeing innovation, whether it's in asset classes. So thinking about, everyone first of all thinks about what you're doing in equities, but actually the role that credit plays. And then we think about some of the private assets, again, renewable energy infrastructure, the very, very important role that those asset classes will play in delivering sustainable outcomes. So there's asset class innovation. And then there is within this thematic space, growing focus, for example, on nature. So I think it is fair to say that everyone has recognized that climate represents the most sort of significant sustainability challenge we face. But attention is moving beyond sort of carbon and carbon emissions into how we support our planet and the role that nature can play in transitioning to that net zero world. COVID, again, thinking about Damien's opening comments, put the focus back on S. So the role that we play in supporting deprived and underprivileged areas as well. So we're seeing innovation happening across all of those core themes. And then the other area that I think is of growing focus is around the role that engagement and shareholder activism plays in supporting companies on a transition. Because when I think about where clients are on their journey, this goes back to, are you trying to only invest in the people that are good today? And that might be actually quite a small universe of companies. Or do you want to invest in those companies that recognize that they're facing a very competitive dynamic market, that there are commitments around delivering net zero? So how does your business need to adjust, need to adapt? How do you support your workforce if you need to retrain them? How do you think about product innovation to deliver to new consumer needs? It actually, active ownership can be a very, very key part of that transition. So we're seeing innovation in all of those spaces. And I think that's what makes it so exciting. It's also what makes sustainability so challenging, because it, go back to that very first comment, it means different things to different people. So you have to be really clear on what a client goal is, and then how the solution you're delivering is meeting that client goal, because there is certainly space for everything, plus a whole host of other things that we haven't talked about in the sustainability agenda.
Okay, great, thank you. I've got one more question before we take some questions from the audience, if that's okay. I think we'd all agree that the goal has to be making sustainable investing truly mainstream. We touched upon it earlier. So creating opportunities to solve these remaining sustainable global issues. Lou, we are lucky to have representation from across the value chain here. What role does EQ play in making sustainable investments mainstream?
Big. I think it's worth noting why we should make sustainable investing mainstream, and then how. So why is because, first of all, there's significant issues out there, and we also know that there's significant client demand for this, and there's a big gap that we need to fill. And mainstream is probably the closest we'll get to where the demand sits, and we're still far away from it at the moment. So there's a big gap to fill, right? So we're still not there, and I don't think we're there generally. However, it is so important because capital has power. If you're moving money from where it used to be in old growth stories and companies that are not treating stakeholders responsibly, towards companies that are creating value not just for shareholders but for society as a whole, you're changing, I guess, the financial system and what it's out there to do. It is trying to reward companies for more than just shareholder return, and this is something that really, making sustainable investing mainstream can do. It can change the way that we're giving companies value in our society. So that's why we need to do it, because it has a real impact on society by shifting capital, right? What does EQ do? So EQ reflects on the innovation that is happening on the asset managers, reflects on what the client needs, and we are the go-to person for you to create portfolios that match your client preferences. We're going to be the partner here. We're so driven to create the best and most ambitious portfolios to fit each client preference, and we recognize no client preferences is the same. So we create the solutions out there, and we push to make sure that these asset managers that we select maintain their transparency, maintain their adherence to why we've picked them, and keep pushing the boundary and creating that capital flow that will make mainstream investment sustainable investment. So hopefully that answers it.
Yeah, absolutely. Before I come to anyone else, do we have any questions from the audience at the moment? It's showing. There we go.
Thanks. So Europe has clearly led the way in sustainable investing, and I think the US still lags in many ways. And this is obvious, I guess, from what asset managers themselves are doing. So Schroders is maybe a good example. We have net zero plans in place. Why is the US, or why are some US asset managers misplaced when they say that they don't want to set net zero plans?
Really good question. So I'll start, and then I'll certainly welcome other people joining in. So I think we are currently in a rapid period of people adopting climate ambitions. And it is fair to say that European companies generally, and therefore European financial services and European asset managers, have been quicker to adopt long-term net zero goals. And you can see this, for example, in something like the Science Based Targets Initiative, where you look at companies that have had their net zero ambitions validated. The very significant majority of companies validated today actually sit in Europe. What we're beginning to see is obviously an acceleration outside of Europe. I think regulation, if we go back to push and pull, regulation has certainly, because it's moved quicker in Europe, has certainly focused the attention earlier across Europe. In the US, you're probably aware of the polarization you're seeing. So there is significant pushback around companies and also particularly asset managers in committing to net zero from certain areas. So if I think about what's going on in Texas, but then if I look at some of our Californian clients, they're actually probably even ahead of some of their European clients. So it's a very complex web that you have to navigate. And I think the critical thing when we think about this from an investment perspective, and again, recognizing that spectrum of client needs, when we think about our net zero ambition at Schroders, that is about ensuring that companies are well positioned to move through the energy transition that is inevitably going to happen. So as a result of what happened in signing up to the Paris Agreement, the entire globe has put itself on that journey. And what we're seeing now is country by country action plans being put in place to deliver against that ambition. And so for the UK, when you think about the SDR framework, this is part of the wider green ambition. And therefore, this will be the regulation that is supportive of us delivering in part that decarbonisation pathway. So I don't think US companies are necessarily as reticent to do it as perhaps all of the headlines, but I think they are now starting to gather that pace.
Does anyone else want to add to that?
Yeah, I think maybe, our view is that it's important to recognize that climate transition is going to happen and regulation is going to go this way. So it is the right thing to do in order to align with that and the risks and opportunities that derive from this, just from a purely financial return perspective. But I think also, again, going back to kind of the power of capital, I guess investment managers in COP last year, I don't want to talk about this year too much because it's a bit depressing, but last year, what we saw is a lot of investment managers for the first time, I think, realizing that they have some power in this and they can actually create some change. And I think that this dual materiality of if you set yourself a target and it is maybe a little bit more ambitious than what's going on around you, you as an investment manager are more incentivized to engage with a high ambition, to vote with a high ambition, and therefore you are actually creating that change. So you're not just waiting and acting on it, the risks and opportunities that are happening around you, but you're actually contributing to it. So there's these two angles, I think, that you're missing out if you're not thinking about it.
Great, thanks. Do we have any more questions?
Hi. With the market wobbles earlier in this year, which I guess particularly impacted sustainable investing, following that, I think largely Article 9 kind of funds and Article 9 portfolios, those end clients tended to stay the course, and Article 8 largely kind of left, not largely, but quite a few left. How do you re-engage with those people? And do you think there's more of an education piece for kind of the longer term outlook for those sorts of clients?
It's a really interesting question. I think a lot of this goes back to suitability, and I'd love to hear Matt's point on it as well, is that when you're investing in a sustainable portfolio, it comes with its tilts and nooks and crannies, right? You're not investing in the benchmarks, and you're doing this because that's exactly aligned to the client preferences. I think if you are an Article 9 investor, let's say an impact investor, it's more likely that your advisor would have outlined that to you in the very beginning, because impact had a more material influence on your suitability. And Article 8 really is just introducing ESG, I guess, information in your investment decision making, having some sort of ambition to this, which previously led to our performance for 8 to 9 years. So it's likely that some, I guess, clients would have not been so aware of the style biases, market cap biases that they're buying into. And they might have been more, the suitability might have been led more by the recent performance. That's my initial issue. I think that's the reason for it. And I think the answer to this is to create greater client understanding of what type of biases you buy when you're buying certain sustainability objectives. We created a comparison document recently, and we're actually adding to this to showcase some of the market cap style, sector biases, screens, non-screens, that come with each of our portfolios, just in order to really be very specific about what the client buys and what it doesn't, and what impact it might have on short-term performance that we've seen in the last year. I think it's all about education and having these conversations, and I'm sure it's really difficult, and please let us know if we can help.
Matt, I wanted to sort of leave that last sort of question with you, tying it all together, sort of how we re-engaging investors that may have been scared off by that sort of those market wobbles, and getting more people on to join us on this journey of sustainable investment and making it mainstream.
Yeah, so I think I think you're right about the difference between the two. I think your impact investors probably understand what they're doing, and they care as much maybe about their social outputs as they do their performance. For those that have had that ESG screen, particularly if it's been implemented quite recently, then the performance definitely needs a conversation. Damien actually made a really good point earlier about some of the problems potentially in some of the stocks that have done better this year. So for those clients that are feeling like they should have had some oil company shares this year, I think if you look at the fundamentals of some of those companies, for all their, whatever it was, 460 lobbyists they've just sent to Egypt for the latest COP, and their abilities to water down what's come out of that, those companies are in real trouble if you roll forward more than a few years. And therefore, to take the tobacco as an example, from 2018, when markets realised that tobacco companies had run out of people to sell cigarettes to, typically in the third world, then their share prices crashed, and they crashed quickly. Now I'm going to steer well away from making any predictions about any single company's share price, but I think if clients think that they would have done better being unethical through this year, they need to realise that's just a really short-term period. And I think over the forget the long term, over the medium term, there's some serious issues embedded in some of these companies. A lot of those companies cannot burn what they've currently got planned, because they'll end everything for the majority of us. So at some point, the politicians will catch up, and at that point, I can only see those the performance suffering if you've got an unethical portfolio. Now that's quite hard to tell a client that off the back of what we've had in the last few months. But again, it's that mantra of what the medium term, what the long term holds, and why we're doing it, and why we think it's sustainable in the medium term.
Fantastic. Well, that's almost perfect timing. So thank you very much for all of your input, guys. It's been fascinating listening to you all. Thank you.
Thank you.
Thank you.